everybody in YouTube land. This is Tom Rudy MVP, and this is MACD Divergence Part 4. In this last video, I just want to show some divergences again. In Part 1 and 2, I explained what divergence is. In Part 3, I showed MACD divergences that did not work, and when they don't work, cut your losses small, and if they break out in the opposite direction of the divergence, that's a very powerful signal. And I personally like those trades also because it tells me that the market is strong enough to shrug off any divergence and keep going in its original direction. At any rate, let's talk about part 4. We're just going to point out some more divergences, basically. Just some really nice trades here. Here in the euro dollar on the futures, we've got back in June here. Oops, let me get rid of that. Back in June, we had a bullish divergence. Market goes to a low, MACD goes to a low, market goes to a lower low, the MACD goes to a higher low. That is bullish divergence. And it's kind of funny because on TV, all the financial shows and the experts, right around in here, like a week before the bottom, all the financial gurus were talking about how the euro dollar was going to zero, and the world's coming to an end for the euro. And the thing that's funny about that is, like 2 years ago when the dollar was crashing, they were talking about the euro dollar becoming the new standard and the US dollar going to zero. So it's kind of a kick to get. It's a kick to hear what some of the so-called financial gurus in the media. It's just funny to listen to them once in a while. Okay, anyway, here we go. Bullish divergence. The media comes out here, euro dollar's going to zero, market goes to a lower low, we got a bullish divergence. So we got the green light to go long right around in this area when the lines cross. And lo and behold, the euro dollar had a nice run. A really nice run from 122 to 132. I mean, do the math yourself. In futures, that's a huge run because of all the leverage in the contract. But I also want to show something else, that sometimes you can combine these divergences with other patterns. And for some of you out there, let me get rid of the divergence here on the chart. And for some of you people that know chart patterns well or familiar with technical analysis, not only do we have a bullish divergence here, but what do we have forming? I mean, it's plain as day. Everyone that's familiar with charts can see that we got a classic head and shoulders bottom. And for those of you that don't know what a head and shoulders bottom is, you can search it. It's a classic chart pattern that's been around for decades, probably 80, 90, 100 years, probably since markets started. But at any rate, it looks like basically it looks like a person standing upside down. Here's the head. Here's the left shoulder, here's the right shoulder, and right in here is the neckline. So when the market crosses above the neckline, that confirms the head and shoulders bottom, and off to the races. So sometimes you can combine these. A bullish divergence will show up, and also a classic chart pattern will show up, which really personally gives me more confidence in the trade. You got two things going for it. Now, it doesn't mean that it's going to be a winning trade. Still could be a losing trade. The euro dollar could have popped up here and then started downwards again. But in trading, I mean, you got to call them as you see them, and we never know. Nobody knows what the markets are going to do. But when you have two chart patterns show up here, that really makes you raise your eyebrows a bit, like, Okay, over here in the euro dollar in mid-October, market makes a high, goes to a higher high. MACD makes a high, goes to a lower high. The lines cross right in here, get the green light to go short, and it's been fun ever since then. let's go to sugar. Sugar has had a huge bull run in the last 6 months. But what's funny about sugar and the media and how charts work, it's just let's just go through it. Okay, here we have MACD bullish divergence. Over in here, sugar makes a low, makes a lower low. MACD makes a low, but makes a higher low. That's MACD bullish divergence. It's telling me the bears are running out of steam and we might have a bottom in this market. Might is the key, okay? Nothing's guaranteed. Now I want to stress that. But here's one that did work in sugar. So we get a green light to go long right in here. And look at this market. Throughout the whole 6 months, it's been making higher highs and higher lows. Even through here, the low still just held, just barely. Making higher highs, higher lows, higher highs. All the way up until this huge down day, and then that's just a no-brainer, you know. That's just huge. Look at that huge down day. I mean, just get out. If you didn't have a stop in up here, which any normal person would, just get out the next day, you know, just bail. But it's just funny how, you know, the media didn't start talking about sugar till, you know, up in here, you know, a couple weeks before the top. And another thing you want to look at in markets is when a bull market starts, you know, the daily ranges are pretty small. You know, nobody's paying attention. You know, nobody's really paying attention. And start getting up in here, getting a little attention from the media, then you're really getting attention, and these days just start getting more wicked, more volatile, and then finally, huge down day, another huge down day. Now the media is all over this, and the daily ranges are just huge compared to over here when the baby bull just started, when it was just born, you know. So that's something that's also you want to look out for markets when they start getting these huge whipsaws, and you just go, okay, let's bring up our stops. Let's just, you know, this market's gone parabolic. You know, everybody knows. Over here, everybody knows sugar's gone up. It's in a bull market. But over here, nobody's paying attention. But the charts posted a MACD bullish divergence telling me that the bears are running out of steam, and this market could go into be the birth of a baby bull market. And it was a baby bull till about the last couple months, and it really took off. Okay, heating oil. Let's talk about heating oil. We got a couple divergences here, and what I want to stress in this chart is how often do these divergences happen. They don't happen that often. Here's heating oil, and this is like a 9-month chart, and we've got, in the last 9 months in heating oil, we've had two MACD divergences. They both just happen to be bearish MACD divergences, but you know, over the course of a year, in any given market, MACD divergences happen maybe 1 to 3 times a year, you know. So they don't happen that often, but when they do, they can be pretty powerful. So if all you ever did was trade MACD divergences in heating oil for the last 9 months, or any market, bring up any chart, any market, and just look at them. You know, you can look in the past, wow, that one worked. And so far, this one worked. I mean, we haven't gone down a whole lot, but at this point, your stop should be at least break even where you don't have any risk in the market. So I want to stress they don't happen a lot, but I kind of like that because trades that don't show up a lot, but when they do, they can be fairly reliable. Okay, that's it for MACD divergences, part 1 through part 4. And we're going to make some new upcoming videos in the future, so stay tuned. I'll be talking ADX, definition of trends, and some support and resistance stuff. So thanks a lot.